Good afternoon, and thanks for joining us for this session. Our session this afternoon is titled Funding the Transition, How Not to Break the Bank. We really couldn't be more excited about the four individuals who we have joining us as our experts for this panel. Each of them has storied careers and are well-known quantities in the energy space, in particular in the finance arena, and are tackling this question about funding the transition, operating at the forefront of industry, finance, and research. So during our discussion today, we're going to cover a number of perspectives ranging this topic anywhere from changing investment and capital strategies to perspectives on the influences of the ESG movement. A note to our audience, we're talking about funding the energy transition. So this is a very broad topic, and we have some of the best experts that you'll have access to anywhere. I want to really encourage you to use our question Q&A function on the platform to submit questions as we go. And I'll do my best to surface those and ask those at the right moment throughout with our experts. And a quick note, that ask a question button is at the top right of your screens. Okay, so let's get started. I'll introduce our panelists. Keep in mind, you can find a longer bio on each panelist in our Energy Week website under the speakers tab if you want to see a little bit more about their backgrounds. And I'll ask each of them to give us a little bit more on what their current role is and their backgrounds once they're into their first comment. But to start, there is on our panel, Jonathan Silver, who serves as a senior advisor for Guggenheim Strategy. Good morning, Jonathan. I'm sorry, Guggenheim Securities. Apologies for the... Next, we have Barbara Berger. Barbara is president of Chevron Technology Ventures and vice president for innovation. Good morning, Barbara.
Hey there.
David Bodick. David Bodick is senior director and sector leader of S&P Global Ratings Public Power and Electric Cooperative Practice. Good morning, David. And finally, we have Dr. Sue Tierney. Sue is with us from the analysis group, where she is a senior advisor. Good morning, Sue.
Hi.
Great to have all of you. So we're going to jump right in. And I'm going to start the conversation high level. Sue, I'd like to start with you with this first question. Would you give us your perspective? What new directions in energy finance, from technology to investment strategies, do you expect to take shape over the next 5 to 10 years?
Thanks, Eric. It's really exciting to be part of this Energy Institute panel, so thank you very much. I'm going to start by highlighting some of the findings of a February 2021 report by a National Academies panel, and the report's called Accelerating the Decarbonization of the U.S. Energy System. This is going to be a different take than you'll hear from the other panelists, my colleagues here today, because what I'm going to talk about is a number of federal budgetary actions and other policies to stimulate private finance and investment in the decarbonization and the clean energy transition. So that's why I'm talking about this. Varun Rai from the Energy Institute and I were part of this. Well, we still are part of this National Academies Committee, as are many of the other speakers at the Energy Week this week. Today, Danielle Dean Ryan is in the panel after us. And yesterday you heard from Julia Haggerty, Clark Miller, and Vivian Lofness, also from the committee. So here's the report. The committee was asked to answer the following question: what's going to be needed to meet a net zero greenhouse gas emissions target for the US economy by 2050? We were not asked, is it a good idea? We were asked, take that target and tell us what's the, that's the objective function, how do we get there? And we focused in this first of our two reports on the question of what should the federal government be doing during the next 10 years to put us on track for that target. So we lay out a number of dollar policies, use of federal dollars and other non-monetary policies to stimulate private investment, create jobs, encourage clean energy manufacturing in the US, technological and social and institutional innovation, social equity and environmental justice, and many other aspects of the energy transition. I won't go over all of that by any means, but we conclude that the net effect of those policies that we lay out and the private actions is that there will be a feasible and affordable transition. So it won't break the bank, according to us, but there'll be a lot of new capital flows in the economy. For example, we point to the need for $2 trillion of incremental capital that will be needed to change out the energy using, producing, and delivering system. But we think there'll be enormous savings in energy expenditures, principally related to buying gasoline, avoiding buying natural gas for heating buildings, and other operational costs that will offset those capital requirements over the decade. So this is investment in more efficient buildings, more efficient vehicles, more efficient appliances that helps us to reduce overall energy expenditures. And because much of that investment is going to go to modernizing and electrifying end uses, then there will be lower overall energy bills, even though there'll be higher electricity prices, higher electricity bills, but that will drive lower overall expenditures in the economy. So this is investment with a payoff for sure. So I'm going to tell you I'm going to tick off a number of the policy recommendations, and then I'll pass it on to colleagues. First, remember, we weren't asked whether this is politically feasible. We were asked, what will this take? So starting point, we would put a $40 a ton carbon price on energy in the economy. That would produce $2 trillion in investment, or that would produce $2 trillion in revenues over the next decade. And there would be other sector-specific policies like a clean energy standard for the electric sector, vehicle standards for cars, and those are not on the federal budget. So things that we recommend to be funded federally include R&D on clean energy technologies at 3 times the level that's invested today. So that would be about $200 billion over the next decade. We would recommend Congress establish a federally funded nonprofit green bank called the Accelerator. That, on our recommendations, that would be $60 billion. There would be expanded support for low and moderate income weatherization and electrification. We would have a GI bill, a GI type of bill for getting the workforce and researchers and technicians and so forth who are ready with the capabilities for a clean energy economy. There are incentives for clean energy manufacturing. There's a national transition corporation to help those communities that are going to be losing jobs and economic revenues locally, and block grants for transitions as well. So let me stop there. As I said, we concluded this doesn't break the bank, but it's going to require a lot of new capital flows.
Sue, I want to jump in with a quick question. So you mentioned one of the proposed solutions was a large investment in a national green bank. So I think for the 5 of us, we probably know a little bit of the parameters of what that is. But I used to work at NYSERDA right next to the green bank, like across the hall. And I remember constantly having to explain what our green bank was. But can you tell us, from the scope of what's being called for in the decarbonization report, what's a green bank, and what is this specific green bank? What's the timeline it operates over? Where is it going to be impactful, and why is it additional to the work that some of the other folks on the panel are doing in the private sector?
Great question. And New York was really one of the leaders in setting up a state authorized and seed funded green bank. There are many states around the country that have already established them. There are many states around the country that are trying to establish green banks. And what these do is provide leveraging of projects that are either too small a scale, too risky in some sense, but would provide enormous benefit to different constituencies and have payoff over time for a transition to a clean energy economy. And those local green banks basically have a investment queue that for each dollar, I think the stats are that for each dollar of the infusion from the green bank, there are $3 brought forward from private capital. Now, a national green bank would be an attempt to try to scale up and move the level of funding for those existing state green and local green banks, but it would also provide scale for projects that really cross state boundaries. So think, for example, of interstate transmission enhancements, where you really need to pull in a variety of different states to get the job done. It might be involved in other things that can monetize the work that's being done in many states and aggregate it up for financing purposes from other places. So this is being introduced in Congress. It's already been introduced, I believe, in the House. It's called the Clean Energy and Sustainability Accelerator.
Fabulous. Thank you so much. That's just critical information. I really appreciate it. So let's see. I see Jonathan Silver. I see you're unmuted. Would you like to take us next to your point of view and tell us about what you expect for new directions in energy finance?
Sure. Well, Sue did a great job, I think, of laying out the policy framework within which a lot of the decisions and financing tools will be established from the public sector side. So maybe I'll just identify a couple of things from the private sector side that are already beginning to make important contributions, and I think have a significant role to play over the next few years. One of them, which I'm sure everyone's reading a lot about now, are SPACs. If you don't know what a SPAC is, it's essentially a blank check company. Public funds are raised in a public entity, and then that public entity goes out and acquires or merges with a private company and brings it public. SPACs are becoming a major force now in the ESG space in general, and much more broadly than that. There are probably 500 SPACs in the market today, about 40 of which have some kind of ESG focus to them. They are important because regular way IPOs have become very costly and time consuming, particularly for emerging tech companies. And as a result, the SPAC is an attractive alternative model. One of the fundamental reasons that's the case is that emerging technology companies can use forward projections rather than just historicals, which is what an IPO limits them to. And it's a way of getting a lot of capital to clean economy companies quickly. I think they're here to stay, despite the fact that there is some fluff in the market right now. There's a little bit of a heady market because, on the one hand, privately invested companies require some kind of public exit for the private sector investors, private equity investors, to make a return. That's number one. Number two, there really aren't enough publicly traded companies in the clean and sustainable sector for retail investors to be able to participate in. And third, pension funds and endowments increasingly have mandates which require them to make investments in publicly traded companies that have those characteristics, and there just aren't very many of those. So I think over the next few years, you will continue to see SPACs play an important financing role in ESG generally, and in clean and sustainable companies in particular. A second, I won't call it a trend because it's been around for a while, but a second area you'll see continued activity is in venture debt. Venture capital is a very difficult way. I was a VC for many years, and venture capital is a very difficult way to invest in clean tech in general. And that's because, as everybody knows, generally speaking, these companies are capital intensive. The investments are often illiquid. And to a certain extent, particularly with renewables, for example, they have bounded returns. Utility scale returns now are in the 5 to 6% range, which is just not attractive for venture capital investors. So an alternative is venture debt. Venture debt generally is capital put on top of venture equity investments, but you will see it in a more general form in the form of green bonds. And in fact, that area has become very, very significant in the last few years. Sustainable bond volumes doubled in 2020 over 2019. I think it was something like $540 or $550 billion of sustainable bond issuance. And that's on both corporate and sovereign bonds, both of which are attractive. So in the last year, Apple, Toyota, Unilever, all of them issued corporate green bonds. And I think we'll see a good deal more of that. And the last thing I'll touch on, although I certainly agree with Sue, green banks and others are other kinds of platforms that will be relevant. Maybe the next big wave of private sector finance you'll see is in securitization. And securitization is really nothing more than the aggregation of various financial instruments like bonds, for example, and then slicing and dicing them against their risk and return profiles to make it easier for individual investors or institutional investors to acquire the risk and reward packaging that they want. There is now enough debt in the market and enough investment in the market in general that the pools are big enough to be divisible. And so I fully expect over the next 3 to 5 years, a good deal of green securitization to take place. So those would be some of the things I'd identify for you.
Jonathan, thank you so much. Your perspective is so rich. I would have been reticent to ask folks to discuss SPACs. So since you brought them up, so gingerly, I want to actually follow up. I have one question for you before we move along, just because that was such a nice seeding. Are there fundamental differences in who's participating in financing via SPACs? Are you actually, from your perspective, if there are 40 clean tech related SPACs in the market, are these different investors, or is it investors, the same cast of investors getting involved in a new vehicle? How would you describe that?
That's a harder question to answer than you might think, because raising SPACs is actually a two-part process, and there are two different kinds of investors. So the first thing, I won't draw you into the boring details of it, but the first round of capital is how the SPAC becomes a public entity through its IPO. And the investors in SPAC IPOs of all kinds are typically hedge funds. And the reason that that's the case is that a SPAC investment gives you a unit that includes a share of stock and a piece of a warrant. And the warrant and the stock are separable over time. If an investor, a hedge fund, decides not to go forward, it redeems and it gets its money back, but it gets to keep the warrant or the piece of the warrant that is attached to it. So it's a unique feature of the SPAC marketplace. Once you have the capital, you go out and you find a company that you want to merge with. You then, the SPAC sponsors, the people running the SPAC, then raise what's called a PIPE, which is essentially a private structure that will invest in this public vehicle. Those investors are long-only investors. Those are the Fidelities of the world, pension funds and endowments, et cetera. And so their perspective and the hedge fund's perspective are very different, and their timeframes are different, et cetera. The hedge funds have no double bottom line. Many of the endowments and pension funds now do in this area. So that's why I say it depends on which pool of capital you're talking about.
Excellent. Thank you so much. Okay, I think that I'm expecting we're going to get some questions about that, so I thought we might as well clear it out at the start here. That is great. So see how strong we're already starting off with these experts. So next, I'd like to go to Barbara. Barbara Berger with Chevron Tech Ventures. Can you chime in now? So your perspective, your background, and tell us, what do you expect in terms of new directions in energy finance?
Sure, and great to be on the panel. And one of the keys of a successful panel is to put people with different perspectives. So I think you've done a good job on that one. So I run the corporate venture arm of Chevron, and I'll talk a little bit more about Chevron as we go on. But We've been around for about 22 years, so longest standing corporate venture in oil and gas. And our perspective is different, right? Because we are using venture capital as one avenue by which we support and access innovation. So relative to, energy is very broad, and we invest across our core business as well as the future energy or energy transition. What I would say is, there's a lot happening in this space. So some of it dovetails with some comments that Sue, brought up in that, we need more innovation. So when we think about that future energy system, when we think about 2050, there's a lot of things that are available today, but they don't get you to net zero. They get you further than we are right now, but they're in all of the various pieces. There's hard to abate sectors. There's how do you take the grid and make it both low carbon, but also resilient. And so, you come back to that research and very excited that the program she talked about and the study that they talked about that they recommended increase funding really in two parts of, from the R&D side, but also up to the demonstration side. So if I think about my world from a corporate venture standpoint, there's a diversity of players. So, we have about 350 co-investors right now. And I would say that's some sort of curve that has accelerated in the last few years, and it continues to. And the investors are other corporates. The investors are financials. The investors are impact funds. The investors are high net worth. The investors are private equity that are coming down into venture, some early stage, but late stage. So there are a lot of new relationships to come together. And, we find that to be actually a good thing, to have a diversity there. I think the other piece of it is that there's a more holistic approach that, because I think energy innovation and as mentioned that the energy venture capital is hard. Some of these are very tough problems. The time horizons are longer. Turning science into technology into a business, and then what is the business model is a lot of challenge. And so I think there's a more holistic approach. The Department of Energy has certainly weighed in on this. Bill Gates and the Breakthrough Energy has weighed in on this. And so we see the confluence of goals, non-financial goals like net zero, either at a country level or at a company level, very much driving what people invest in or what companies invest in and how they work it. And the last piece I would say, and it's just a plug, is that innovation that can't scale is interesting, but. And so the incumbent energy companies have a vested interest in stuff that can scale and can make a difference in the system. And so the ability to help with that scale is something that we certainly have a reputation of doing. We're finding that's increasingly valuable as you have a diversity of investors, is not all of them have a test kitchen that is called a global operation. And we've honed our ability to use that for the benefit of the entrepreneurs as well as for our own company and the other investors. So I'll leave it at that, and excited to talk more about this area. A lot of things happening.
Absolutely. Bara, it is so exciting to have a corporate venture capitalist with us. It's such an important area. And I just want to mention that it's an incredibly important area for Texas. And we're hosting you from UT, but I really want to call out that Houston, Dallas, Austin, the corporate venture is a major part of our ecosystem. And so I really want to make note of that. But I have I have a cheeky question for you. So I want to paraphrase George Will questioning our former Secretary of Education and ask, why must you exist? So here's why I want to ask you that question. There's a lot of venture capital. Why do you need to drive innovation in the power sector? What about a CVC? Is it the strategic alignment? You mentioned core and future though. So are you, is it because a CVC can look at the trajectory and kind of skate to the puck, and in a way that like financial venture can't? How do you most crisply summarize why a CVC is such a critical piece for a large corporate, and why we see them doing such kind of unique functions within the financial space?
Yeah, no, great. I thought you were going to be cheeky and call you like Houston, a suburb of Boston, and I was going to say, right back at you, guy. So, I think you can look at it from both perspectives. From a corporate perspective, the ability to constantly be able to have an eye to the outside is critical. Our companies are focused on execution. It's what we are good at. And so being able to see where things are going and to be able to access, and it's not easy for the little guys and the big guys to work together. So a corporate venture plays that role as an on-ramp into the company. Now, what do we provide to the set of investors and to the startup? We know the current system. And we know how it works. We know where the opportunities are. We know where the limitations. Not a complete set of information, but we have a pretty good handle on that. And when I mentioned the importance of scale, we're not going to throw away what we have as an energy system. It's going to evolve. Things are going to have to be integrated in. And, that's where we see the alignment with the corporate strategy, and our business will evolve. So, I think we bring that to the startup and the other investors. And so it's not just money. It is all that we know and the capabilities we have within our company.
Let me add, if I could, a couple of more to that. I spent 10 years as a VC, but not as a corporate VC. And I think corporate VCs are essential. They're critical to the venture mix. In addition to the things Barbara talked about, she didn't give herself and her colleagues enough credit for a couple of other things. They have a unique capacity to test the technologies that independent companies are building throughout their own ecosystem, which no independent venture capital firm can touch. And in addition, and I'm not being facetious here, they also have the capacity to buy the product. And that's a non-trivial aspect of building a company. So as a VC, we were always interested in and excited to have good quality corporate VCs, and Chevron certainly is one of those.
So Jonathan, thank you. I'll just some stats for that, and I'm very proud of these stats. Over 80% of the companies we've invested in, we've found some way to trial their stuff, whatever their stuff is. So over 80%, which is beneficial for us as well as the company. And over half of them have some commercial arrangement with Chevron. Yeah. So you're right. That's what we lean in with. And, it's probably why we've been successful over 2 decades. Thanks, Jonathan.
Fabulous. Thank you so much. Listen, going forth on this panel is like truly following Streisand here, but we have David Bodick, someone who is a true expert and at the 10,000 feet level, and is a professional in being on the conference circuit. David, bring us, your perspective. You deal with a different area entirely, but also see a lot of the same, look at a lot of the same broad trajectories. Could you bring us up to speed on your perspective?
Sure. Thank you very much, and good afternoon, everyone. Eric, I want to first and foremost thank you and the University of Texas for inviting S&P to participate in the program. So I welcome the opportunity to add a varied perspective on this panel, because we at S&P are neither policy advisors nor investors. So we come at this discussion from a slightly different perspective. My group at S&P is, together with my colleagues who follow investor-owned utilities, assess the credit quality of electric utilities As part of our analysis, we explore the prospects for preserving financial stability as utilities transition from conventional generation to cleaner power production. Among the many factors we look at when considering ratings and ESG attributes of the electric utility sector, we look at the financial and the technological feasibility of the transition that the other panelists have referred to. We believe that decarbonization goals are laudable goals, but piggybacking on some of Barbara's thoughts, in the near term, we identify some technological and financial hurdles, specifically blackouts in California this past August and in Texas in February highlighted some of the operational shortcomings of intermittent renewable resources and the critical need for firming capacity. Firming capacity could take the form of conventional generation, or it could take the form of storage. In terms of storage technologies, I know Sue has written about investment and spoken about investment in storage technologies. Where we stand today, we believe, we at S&P believe there's a long way to go to get there before reaching critical mass or scale, as Barbara had referred to. At the same time, if we turn the clock back a number of decades, we look at President Kennedy in the early 1960s, who challenged the nation to get to the moon by the end of the decade, and we did so. And with some of the policy platforms that are being put forward now, we may be very pleasantly surprised. But where we stand now, the mix of generation resources truly matters in terms of having a resilient grid and having reliability, because again, we've seen from some of the recent experiences that the mix that within some markets does not translate into a lot of stability.
David, thank you so much. Like I said, you have this unique perspective that we're glad to have with us today. I'm going to move on to another question, but this is related to the comments that have come up. One thing that is, has been a truly kind of taken over a lot of discussions in clean energy finance is around environmental social governance. And Jonathan, I know you're an expert on this. You've discussed this at length. I'm sure everyone's familiar, but I want to ask something very specific. I'd like you to tell us, how is the ESG influencing what you're doing? But also, I'd like a little bit of context. How did this go from being, an ESG movement, go from the limited partners and translate into the actually influencing the decisions that are being made on the ground? Because a number of years ago, it was, white paper land, and it's truly like an influential part of the ecosystem now. How did that happen? And then how is it, impacting your work? And Jonathan, if you don't mind, maybe we'll start with you.
Sure. Well, it's a really interesting question, and it has a long and rich history, which we probably don't have time to go into here. But I just want to make a couple of points about what you're referring to as sort of the ESG movement, because it is really unique in a couple of ways. First of all, ESG metrics are by definition non-financial metrics, right? So it's amazing that companies use them at all. I think it's largely a function of the fact that both their consumers and their employees, are demanding it. The market is receptive to it, and the executive leadership of these companies understand that it's an important new aspect of what they're required to do. I think we should also make note of the fact that, which I think a lot of people forget, and we shouldn't lose sight of it here in this kind of specialized conversation, that ESG refers not only to E, but also to S and to G, right? S for social and G for governance. And so the ESG movement actually affects lots of companies that actually have nothing to do with clean energy or clean tech. But I think one of the reasons, maybe the most interesting reason to me from the private sector side, is that the ESG movement actually turns out to be economically attractive for businesses. McKinsey, where admittedly I worked a million years ago, but I don't think I'm biased, did a report a few months ago about the way ESG affected business results. And they identified a number of areas where it was substantively and meaningfully important. One is to top line growth, right? That's pretty straightforward. To the extent companies become and their products become more attractive to customers, customers buy more of them and revenues go up. Cost reduction is another, right? To the extent that a company manages its E as well as S and G effectively, typically energy costs, water costs, and related kinds of expenditures go down. A lot of companies have seen productivity improvements in no small part due to employee motivation, but also in terms of the way assembly lines and supply chains are built out and streamlined against ESG metrics. And then the last one, which shouldn't be overlooked, although it's not quite as tangible, is asset optimization. Because when you are focused on these longer term metrics, you actually take a longer term perspective on capital allocation. And it turns out that long-term capital allocation is a much smarter way to allocate capital than short-term, a short-term focus is. So there are just a couple of reasons I think it's become relevant.
That's excellent. Thank you so much, Jonathan. Real quick, I'd like to go to Sue next, but Sue, before you chime in on ESG, I'd like to remind the audience we're coming close to the Q&A part of our conversation, so I'd like to encourage you to start submitting your questions, and we'll get around to those after this conversation. But Sue, ESG, follow on from Jonathan's comments there. What's been the experience? And I think you're muted.
Thank you. You would think after a year that I would be used to this. I don't need to repeat everything that Jonathan said, but I would say absolutely spot on. The one thing I would add is, for all the reasons that he described, that the McKinsey study showed that these are economically attractive, I think that those corporations and nonprofits that are looking at their assets and the returns, and that are dipping their toe into a portfolio that really has great ESG metrics, they are finding that they're great financially too. And so it is paying off. I've seen a number of different organizations where the boards have said, we're about finance. Others have said, well, we don't want to just completely go headlong into this. And the testing has really proven very positive in terms of this working for investors, and then all the other reasons, customers, employees, and so forth.
Wonderful. Barbara?
Yeah, I just wanted to add a couple of things, and following on to Jonathan, we're corporate venture, so the first word is corporate. So, Chevron has a very, I think, robust ESG approach. It is all those letters, and each of those letters has many dimensions, and a dedicated team that works with our investors to talk through our approach. And it goes from the board down through management and across the population. One of them, and the one we seem to have quite a bit of focus on today, is part of the E. And so some of the investments we make are part of our overall holistic approach to a world that is, a future that is lower carbon. The last piece, though, that I wanted to mention is us as investors. So this isn't the investors of Chevron. This is Tech Ventures as investors, and it really gets to the S. And it is still a fairly non-inclusive part of the economy. And whether we're talking gender or we're talking underrepresented groups. So the work that we do in our ecosystems, in our communities, are all about that access part, but it's not access for Chevron. It is access for founders of color and for first generation, for women. So to be honest, I know that throughout the investment circles that part is something that we collectively need to do more, because the investment, just like we see the investment isn't spread evenly across technologies, It's also not spread very well across the able-bodied talent that we have out there that can make a difference in the future.
That is fantastic. David, did you want to chime in on the ESG conversation before we move on?
Just very briefly, I'd like to add a thought on the S, a slightly different perspective. So as management G moves forward towards implementing E through decarbonization, by and large, the S perspectives are favorable as we decarbonize and there are health and safety improvements for those who live in the footprint of power plants. But at the same time, there could be affordability issues as utilities that have made long-term investments in generation assets have to then remake themselves and invest in renewable assets. And so there's the question of who absorbs that cost and how burdensome might it be for ratepayers to absorb costs of stranded assets or regulatory assets for historical investments, as well as the investments in new renewable assets. So that's another consideration.
Mm-hmm. And David, you actually broached that really nicely for me. One of the audience questions that we received is, with the change in trajectory of investment, what, apart from coal, where there's been a lot of stranded assets in the U.S., where are the other risks related to stranded assets that folks are attending to?
Nuclear, for one. There are a lot of nuclear retirements because the economics of nuclear power plants has really suffered relative to natural gas of late, as well as to many subsidized wind and solar projects.
Mm-hmm.
And I would say that there are concerns and questions as people look at new investment in fossil generation, fossil pipelines, that depending upon whether we develop carbon capture and storage in a way that is deployed at scale, then there could be stranded assets associated with new, not just past investment in those resources as well.
That's an excellent point, because let's say utilities that are growing and they need firm capacity. If you're going to invest in a combustion turbine or a CCGT, that's a long-lived asset. So the Biden administration is saying we'd like the power sector to be carbon-free by 2035. That's 14 years away. How do you make that investment decision, and how do you go about recovering that investment?
Mm-hmm. Any other comments on that question? If not, I can go on to the next one. I have lots now that are coming in from the audience. Yeah. Listen, I want to revisit just one more thing. I'm loving this acronym, like the utility of ESG here. So going back to the S. So if you were with us yesterday, you would have heard the most focus we've had probably on any conference we've hosted around equity. Now, it's really kind of permeating a lot of different discussions across the energy space in power and oil and gas, from education and R&D all the way through jobs, right? So job program, training and transitioning. But I want to come back, finance. This is a panel about finance. What is the role? So Barbara, you were very generous by couching this and telling us a very specific way. So upstream with investors working on the supply of innovation, but where else does finance play a role in an equitable transition when we're talking about minorities and we're talking about social equity to low-income ratepayers and low-income communities? What's the role, and are there any misconceptions about what the finance piece really can do where we have optimal leverage? Sue, I know you have worked all over this topic for a long time. Could you start us off with a quick response about how you see finance and equity?
Yeah, I'm going to let the experts on private finance talk about it directly from their lane, but I really do see this important role of public policy in both encouraging, targeting, and then creating financial incentives to put investment into underserved areas, to create those investment opportunities where the communities can have wealth creation as well as good jobs and so forth. So I think that the the moment that we're seeing right now, where there is such pressure that has built up, and it needs to be addressed by people of color, by frontline communities. Their needs need to be taken into account in this, and I think that's where there's an important role for government.
Thank you, Sue. Wealth creation, absolutely. This is like, I appreciate you bringing that perspective. So I want to ask Barbara, Jonathan, your capital investors, how easy or hard is it to put, apart from investing in leaders, how hard is it to put social equity into the formula for your long-term strategies?
Well, there are a number of programs, and to a certain extent, a number of technologies which lend themselves to social equity in the space. For example, the PACE program, both residential PACE and commercial PACE, are designed almost expressly to ensure that anybody can relatively easily take advantage of the benefits of clean power. And to the extent that even those programs aren't successful enough, there are actually backstop programs to those programs, which can reduce any upfront cost expenses or other kinds of things which create these disparities. That's number one. Number two, there are some community solar projects around the country now in which a certain amount of the power that's being produced by the project itself is allocated in different ways, and which can serve an important mitigating function in that. And then the last part is the projects themselves, particularly utility scale projects, where they're not stuck in the middle of nowhere in the desert, actually generate a whole series of jobs and job multipliers directly for the affected communities. Sue can probably speak more articulately to that than I can about exactly what those multipliers are, but lots of them do that thing. So, as a general matter, businesses are not selecting projects on the basis of social equity, but renewables and sustainability projects in general have the wonderful side benefit of being naturally adaptable to those issues, and those of us in financing the space always look at those double bottom lines, to implement them as possible.
Excellent. Thank you. That was one of the toughest questions I was trying to ask today, so I appreciate you nailing it. So I have another audience question that's coming in, and so this is, we're getting more and more specific. So will natural gas be attractive as an energy source investment short-term during a transition period, or is there a long-term investment potential as part of the energy mix for firming or to back up renewables? And maybe David, you might be well positioned to give us a little insight. Who's long on gas right now? How does that look?
So again, going to the Biden administration's goals, you would think that natural gas, the future is not very bright on the one hand, but at the same time, in speaking to the industry and looking at the storage capacity that's available and the need for firming capacity, it would appear that natural gas is going to be a critical asset. But one of the things that we saw in Texas in February is that putting so many eggs in the natural gas basket can come back to bite you. So we believe that natural gas will continue to have an important role to play just because of the technological barriers to developing storage capacity in the near term.
Eric, could I add to that?
Absolutely.
I've been doing a lot of thinking about this question, of course, because like David, I agree that there are definitely parts of the country where the configuration of the transmission system combined with the placement of generation will make it so that you're not going to see some coal retirements if you can't replace with natural gas, or if you can't build, a big enhancement on the transmission grid. And yet those new gas projects not only have to make a financing hurdle, but they also have to make a siting hurdle where there will be huge opposition. And one of the arguments in those facility siting proceedings will be, this is just going to create new stranded cost. So it seems to me that there are ways to think about what are the terms and conditions under which you would go forward. One of them would be to say, for a new gas plant, for example, if you don't have the capability built into your project to build on in future years controls on greenhouse gas emissions, say through carbon capture and sequestration, then you have to shut down at that point in time. You either become carbon neutral or you shut down, and that would send a signal to investors as well as planners about what is the cost recovery period in which I have to get a return on my investment, and therefore it will change the economics of a combined cycle or combustion turbine if it's not going to be over 40 years, but it may be over 15 years. And so I think that there are ways to think about the permitting questions and the financing issues as a way to take on explicitly the stranded cost question.
Mm-hmm. Excellent. Thank you so much. And Barbara, I wanted to give you a chance to chime in.
I'll just add something. Sue did a good job with that question, but just, and obviously we're a natural gas producer, and I'm not going to talk about our business, but if you think about where natural gas goes in, obviously power, if you focused on the emissions and the performance of the grid, you'd probably get better answers than focusing on the identity of the feedstocks. But it's also going to go into industry. And there's a number of applications where there isn't an alternative to hydrocarbons at this point, and it goes into feedstocks. So I think, understanding the broader scope of natural gas would be good for investors, not just focusing on the current configuration of gas generators.
Wonderful. Okay. Thank you so much for that perspective. So I want to mention we're nearing the end of our hour, but we still have about 7 minutes left. We got a really interesting audience question that goes back to our ESG conversation. I'm gonna kind of take this literally from our question because I think it's stated quite nicely. So Tariq Fancy, former CIO of Sustainable Investing in BlackRock, wrote recently in an op-ed that the financial service industry may be duping investors with respect to ESG. How do we verify the validity of ESG investments? So take this as whatever direction you want to take that. I think that's a nicely formed question. Want to jump in?
Well, I'm going to say something that I'm risking to be too ignorant about, but let me just give it a try. There are institutions that are quality control on metrics, and having the screen that looks at the different elements that make up ESG is really important to make sure that these are actually doing what they're saying they're doing. And so that needs to be beefed up, but that has to be part of the equation.
Mm-hmm. David should really weigh in on this as the expert, but I will say just one thing, and I say this respectfully, I sort of disagree with the premise of the question. I think that businesses are not trying to dupe anybody, but I think they are struggling to try to figure out what ESG metrics actually mean and how to quantify them. It's often incredibly difficult to figure out exactly what constitutes a measurable, quantifiable element against the UN 14 or any other set of characteristics you want to use. So I'm sure there's some that are doing greenwashing. That comes as no surprise to anybody. But increasingly, businesses take this pretty seriously, if only because their customers take it seriously. Mm-hmm. So I defer to David as to how to really score it properly. But I don't think we should sort of broad brush the idea that the private sector in general is somehow trying to pull one over on anybody.
Thank you. David?
So I think that Jonathan touched on a very good point. Businesses take it seriously because customers take it seriously. And there are utilities that we've dealt with that are very carbon intensive. They're in coal country, who a few years ago under the Clean Power Plan, which had envisioned that about 30% of an all of the above approach, and about 30% of our generation portfolio in the US would remain coal. And they thought, we'll just bootstrap onto that and will remain all coal. But I think that they have responded. We're seeing them responding because their customers are demanding that they respond. And winning over the customers is nebulous. On the one hand, it's hard to measure, but it adds value to a company. There are both qualitative and quantitative attributes to ESG. One can readily measure carbon reduction. It's more difficult to measure the health and safety benefits of the carbon reduction. Sue spoke to creating green jobs, building all these new wind farms and solar farms. But at the same time, how do you measure the alignment of, like, what are you doing about all the folks in coal country that worked in mines that may be losing their jobs, and you might have a geographic mismatch. So some of this is very measurable from a quantitative point of view, but some of this is not going to be very measurable. But on balance, one can look to see collectively, are we advancing societal benefits?
And David, I want to ask just a quick follow-up. But for a little while, there was a lot kind of in the ether about source tracing, right? So there were firms, there were services. Has that rolled into being a real input into the way that you're evaluating sector-wide metrics?
No, it like, just very briefly, no, it hasn't been.
That's very briefly. Thank you. Yeah, exactly what I wanted to know. Thank you so much. Listen, we only have a couple of minutes left. I actually want to open the table to our panelists to make any final comments, things we should be looking out for. There's a few hundred people in the audience and a lot of grad students, a lot of Texans. Final thoughts on the topic. We really appreciate everything you've contributed already.
So can I go first?
Do it.
Oh, okay. Eric, I was waiting for some affirmation. So, great conversation. We could have gone on for a long time. For those in the audience that are students, here's my pitch: energy. We need incredible talent to help us solve challenges that matter. Whether you come and work for an established company, a new company, you're on the investment side, the policy side, the infrastructure side. We need all of those. And so, there's other big challenging problems in this world. So I'm not gonna try to say this is the only one. But the fact that you came to an Energy Week session means that you have some interest in energy, and we will need your talent and your great ideas and efforts going forward.
Well, I'm glad that Barbara went first, because I say hear, hear.
Agreed.
Yes, I'll only end by saying the fact that this panel is about energy finance suggests, I think quite appropriately, that both of those things are now of almost equal importance in reinforcing one another. And so you don't have to be a technologist to be in this space. You can be a finance person to be in this space. And the capital flows here are unbelievably large and getting larger, and only going to get larger for years to come. Almost every financial tool and instrument that we use on Wall Street has now been or will shortly be adapted to the clean economy, with more innovation to come. So finance plays an unbelievably important role in the successful rollout of the new energy, clean energy economy.
Wonderful. That's our time. I really can't, thank each of you enough. This was a truly terrific panel. We all learned a lot. And I just want to really compliment how great it was to have all of you agree. You were definitely our first line for this session. And I'm so happy that you were all able to make it. With that concludes our time for this session.